So you want to get a business degree. You've gone to college or you've gone back to college and you're 2 or 3 weeks into accounting class, your first test is coming up and you're a little bit lost. I have been there. My name is Matt Douglas. I'm a CPA and also a community college instructor, and I'm here to help. In this first lesson, we're going to go over the accounting equation. The accounting equation is the most basic part of accounting. It is assets equals liabilities plus owner's equity. Now, those are probably new terms to you, and so let's, just in case your instructor or if you're taking this online, you're not sure what these are, let's talk about what assets are. Assets are things that the business owns. Personally, my favorite personal asset is my smartphone. But a business is going to own several things. First of all, they own cash money. It's the best thing a business can own. They can own equipment, they can own land, they can own buildings, they can also own accounts receivable, which is money that customers owe to them. There is also liabilities. These are things that the business owes to other people or other entities, other businesses. They can have debt on buildings and equipment. That's called notes payable. Or they can just have accounts payable. They buy some supplies on account and they've received the supplies, they're going to pay for them later. That's liabilities. And then owner's equity is just what's left over. It's the rights the business has to the assets, or what the business has rights to. Commonly, we're going to have owner's equity referred to as whoever the business owner's name is and capital. I own Matt Douglas CPA LLC, and so my capital account is Matt Douglas Capital. So let's go through a couple problems that you're probably going to normally see on your homework and walk through these. Here's one that says that at the end of the accounting period, this business has assets of 526 and liabilities of 126. So owner's equity is assets equals liabilities plus owner's equity. So what's missing here is $400,000. A way I like to do this also is you can rewrite the equation to assets minus liabilities equals owner's equity. So if we have assets of 526, liabilities of 126, then $400,000 is going to be your owner's equity. Owner's equity, assuming assets increased by 100,000, so now assets are 626, and liabilities decreased by 30,000, so now we have 96,000 in liabilities. I'm not a calculator kind of person, so I like to kind of put these into an Excel sheet. So 526 is what we started with. It increased by 100,000, so now our new assets are 626. And then we used to have liabilities of 126, but now they decreased by $30,000, and so now we have new liabilities of 96, and if we take the assets minus the liabilities, we're going to get a new number of $530,000. And so that is a quick way of how you can go ahead and work through some of these asset liability problems. One of the best ways is to rewrite that accounting equation to assets minus liabilities equals owner's equity. Let's take it up a notch here, and it has a question here. It says a vacant lot was acquired for $115,000. So we always record assets at their cost when we purchase them. We don't record them as what we think they're worth now. Even if this land, it says here, is worth a lot more now, it's originally and stays on our books at its historical cost, what we paid for it in the beginning. And so it says it was sold for $298,000 in cash. What are the effects here? So total assets, we had an asset of 115, but now we just sold it for $298,000. Let's do this kind of this way. So we originally had this asset on the books for $115,000. and now we are selling it for $298,000. Now, a mistake would be to just add those together and say 431, but that's not right, because when we sell it, we don't have rights to it anymore. It's gone. And so we have to take that part of it off the books. And so we now have $298,000. So one of the best ways to say what's the increase? Well, in essence, it's the profit of what we got from this land, because we had $115,000 of assets, but we got rid of that, and now we have $298,000 worth of assets, a different asset, cash, and so our increase is $180,000. We increase by $183,000. We don't have any effect to a liability. We don't change anything about what we owe here. It's the same. And owner's equity is increasing also, because the assets raised by $183,000 didn't change the liability, so the other side of that equation has to stay in balance. So our owner's equity increases by $183,000. I'm using the Cengage project program here. Love using that. Check my work. It's a fun time. All right, so let's say that the seller owes $80,000 on a loan for land. After receiving the $298,000 in cash, they paid the $80,000 owed. Okay, so what's the effect here on total assets? There isn't any change there. Total liabilities, actually we did change, because we paid in cash $80,000 here, because we actually paid it off in cash. No bank is going to say, hey, I want you to write off that liability. I'm not going to pay you. You have to be a really, really big business for banks to do that for you, but not if you're just a normal small business here. So total assets decreased by $80,000. Total liabilities are also going to decrease by $80,000. We used to owe that money. We don't owe it anymore. But the only no change is owner's equity, because, well, we just took one asset, decreased it, and we took a liability and decreased it. Both decreased by the same amount, and so we have the same amount of owner's equity. Is zero change there. Is it true that a transaction, this trips my students up all the time, is it true that a transaction always affects at least two elements? The answer is no. Why is the answer no? Because I could go buy an asset with an asset. So if I took, if I need for my CPA business, I need a new tape dispenser because I hate this one. I go take $10 in cash and I go buy a new tape dispenser. I raised an asset of supplies and I decreased an asset of cash, but there was no change in total assets, and it only affected assets. It didn't affect liabilities and owner's equity. So it's not true. A transaction can affect just one. All right, if you have any more questions, please drop a comment in there. Hey, I'm struggling with this. I am here to help Accounting 1 and Accounting 2 students make A's and go on and get their business degree. I have found a lot of help. I was a 30-something when I went back to school. I went to an evening class at a community college, and I didn't understand a lot of what was going on, and thankfully one of my wife's friends was a CPA, and I was able to ask her, and I want to be able to help any students that are struggling with this stuff. So if you have a question, drop it in the comments. I'm happy to answer. I'm going to be posting more videos answering questions that commonly come up in Accounting 1. Thank you for watching. I'll see you next time.